global economy and this U.S. economy. I mean, given
how
much
manufacturing data get better in parts of Europe.
Better from a very low level. But also think about how much stimulus we put into a full employment economy. We should have been roasting at 3% GDP growth, which would have caused higher inflation, which would have caused higher interest rates. What happened was, though, these tariffs basically rained on the economic growth that was caused by that stimulus, and that's really what changed. That's why I think those 3% forecasts were wrong. I think people just didn't realize that we're going to have this on-again trade talk coming out of the administration.
And we're beginning to get warnings that the tariffs could affect the U.S. consumer, which, as everybody knows, is the
We've had those warnings, though, for like 2 years.
I hear them as more serious now than they have been. There was
Why?
a lot of shrugging when the tariffs first went into effect.
Hey, Contessa.
Yeah,
just
Steve.
real quick. That phrase, global developments, is a catchphrase for everything you guys are talking about. You know, the chatter around here is the extent to which those tariffs, December 15th, I guess that's this Sunday, are gonna happen. And if they do, I don't know. We might see a market that begins to price in more aggressively a rate cut in 2020 if those December 15th tariffs.
We'll see, though. But Steve, you know, the Chinese have been eating a lot of this on their supplier end. Their currency's gotten weaker. I wonder how much of any of that is trickling down to the American consumer at all. I mean, that's the thing.
What I can tell you, Brian, is that we went into this year this time last year, we were at a 3% 10-year rate. We were expecting a Fed funds rate that was going to approach 3% this year. That has all changed, and David Kelly has it, in my opinion, precisely right. The difference there, the delta, is what happened with the trade war. And that trade war is the surprise. And it's like saying, Brian, yada, 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 everything was okay. Well, guess what? Yada rate cut, yada rate cut, yada rate cut. 3 of them, 75 basis points lower, in addition to not the rate hikes we were going to have. It's about 200 basis points of additional stimulus in the system today.
Fair enough. Good point. I just know flat panel TV prices have come down 50% in 5 years, and now they're up 15 from the... Anyway, Steve, thank you very much. All right, so let's get a stock market update with Bob Pisani at the NYSE to see if we can get that rare blue graphic that exactly is unchanged, Bob. It's like the white whale or the blue whale of the stock market.
Yeah, and we did move a little bit, and for good reason. So by S&P, probably about 5 points. Let's take a look. Yeah, there you go. That's about 5 points in the S&P, and very good reason. Steve highlighted it. Appropriate, meaning we're not doing anything right now. We're unanimous decision. That's certainly a good sign. And no real signs of any more rate hikes. I would just point out one thing here. By the way, this move here, mostly industrials and tech. So you saw Caterpillar, 3M move up. Among technology, your Apples and your Microsoft, they all moved up. Bank stocks not moving much, flattish on the yield. You saw there, they were just putting up the charts here, down just a little bit in the last few minutes, but nothing very good. Interest rate sensitive stocks, sectors not moving too much as well. One thing that was interesting, not a lot of changes in the in these individual interest rate sectors, but the Fed did say, the new line here, they will monitor muted inflation pressures. I think there's a sense here, a lot of central banks would like to see rates rise a little bit. You're certainly going to hear that, I think, tomorrow from Christine Lagarde. She's going to emphasize fiscal stimulus over monetary stimulus, and I think that's going to be a theme. So I don't think, given this comment about muted inflation pressures that we are monitoring, the Fed would object necessarily to rates going up a little bit higher. I think the key here, putting off additional tariffs for the December 15th, I think that would take some risk off the table. As Steve's right, it may not make a lot of difference necessarily in some of the earnings pictures, although if those tariffs went in, it would certainly impact some technology companies overall. So let's see how this picture evolves with the December 15th. No additional tariff hikes December 15th would definitely take some risk off the table. Here you see the Dow Industrials now moving essentially into positive territory.
All right, those
back to you.
Scheduled for Sunday. We see what happens. How's the bond market responding to the Fed decision? Let's get to Rick Santelli at the CME. Hi, Rick.
Hi. Let's start out with what actually is moving more, and it isn't the bond market, it's the foreign exchange market. Look at an intraday of the dollar index, making new lows right before and continually after the Fed's statement. Open the chart up for 8 or 9 sessions, and you see how important this is. If we end up closing under 97.25 to 28, we will be moving into territory we haven't closed below in quite a while. And the dollar being heavy and a Fed on pause does make sense. Now, let's get back to the fixed income market. Look at the intraday of twos, okay? You can see that we are now hovering on new low yields. If you open the chart up to a week, you can see it's important, but not as important as a violation of 160, and there's a bit of a cushion. Now look at the 10-year. 10-year also flirting with the new low yield on the day. It was 180 before the statement. It's hovering there now, but it's going to slip through. And if you open that chart up, you can see how important this 180 mark has been. Finally, how do you wrap all this together? Listen, I remember in the last administration, we're all looking for green shoots. In this administration, we're all looking for weeds. But at the end of the day, you can say what you want about uncertainty. The market seems Kevlar uncertainty coated. Back to you.
Well said, Rick Santelli. Thank you very much. All right, now let's thank our panel, by the way. David, Mona, Jim, it was a good discussion. Really appreciate it. All right, coming up, much more reaction to today's Federal Reserve decision, and we are just minutes away for the news conference from Fed Chair Jerome Powell, what he's going to say about the economy in 2020 and what the Fed is likely to do next year. That really is, guys, the question. Remember, there's a couple new voting members as well. We're back right after this.
This CNBC program is...
Christmas. A time for celebrating, unwrapping, and unwinding. Capture every moment with an epic iPhone 6s with a 12-megapixel camera. Now only $12.99 a month from Tesco Mobile, saving you £72. It's just one of the ways we're celebrating 100 years of great value. Go in store or search Tesco Mobile. Tesco Mobile. Every little helps.
Saving £2 per month over 36 months was £14.99. 36-month credit and rolling monthly usage agreements required. Subject to status. Terms apply. See tescomobile.com/terms.
To LeBron. Slam dunk.
The NBA is on TuneIn Premium. Each week, TuneIn picks an NBA game you just can't miss. The Miami Heat are taking their talents to Texas to take on the second-year phenom, Luka Doncic, and the Dallas Mavericks.
Pulls back, trying to make it 11-2.
This Saturday, the Miami Heat are at the Dallas Mavericks. Tip-off is at 8:30 p.m. Eastern. Search NBA on TuneIn to follow your favorite NBA team today.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip Bayless.
Follow and TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
Want TuneIn to remind you when the big NFL game is about to get underway? Be sure notifications are allowed on your phone and search NFL on the TuneIn app. Find the game you want to hear under events and tap Notify Me. We'll let you know exactly when it's time to listen in for kickoff. Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted.
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught. It is in for the right side for the touchdown to Keenan.
Search NFL today.
All right, so welcome back. No surprise from the Federal Reserve. They left rates unchanged. Everybody expected that, and as expected, stocks are mostly higher. But that's not all the story. Joining us now is Frederick Mishkin. He is former Federal Reserve Board Governor. Let's bring him back, of course, Mona and David. So, Frederick, good to have you back on.
Good to be here.
You know, so listen, I don't want to say, you're not going to get up and say, oh, nothing happened at this Fed meeting. There is a lot to discuss as we tried. If you were sitting chairing the Fed board meeting, what would be topic number one for you?
Well, I think the issue is going to be worrying about uncertainty. And the second issue, I think, is what's going to happen to inflation. So the Fed's making a bet. They've decided to cut rates. From a point of view of where the economy is, this was, I don't think, was justified. That I think that the concerns about uncertainty and the trade war, we could get information about that in the future. They acted more preemptively against insurance against it. I'm not sure that was the right thing to do from that perspective. But there is an issue that inflation is low. And so
it's like the chupacabra. I mean, you've heard about it, but it never seems to show itself. And we've got wage gains, we've got tariffs, all these things that should be sort of inflationary just aren't there.
Yeah, I mean, it's clearly a puzzle. And I think one of the key things about doing successful policymaking is to admit when you don't know. So a very big issue is what's we call the natural rate of unemployment, sometimes called the NAIRU. And the reality is we're just not sure what that number is. Now, I actually tend to worry more about this issue that running an economy at this high pressure type of economy could actually cause problems at some point in the future. I think that is...
What kind of problems?
Because there's a view that's very clearly stated, Jay Powell stated this, that the Phillips curve seems to be dead, that the tight economy is not producing any inflation. And actually, research that I've done indicates that view may be not really quite correct, that it has a lot to do with how the Fed has been operating in the past, and hopefully they'll continue doing so in the future. But from that perspective, you have to be nervous about it. But on the other hand, we just haven't seen the rise in inflation that we'd like to actually see. Yeah. And so from that viewpoint, if the Fed really that's the real concern, then it's justified that they want to actually goose up the economy a little bit. And that's what they're doing right now.
So I'm just curious, there is some expectation that the Fed in this meeting would have had discussions about whether they should change the target inflation rate. Is that something that you think should be under consideration?
So there is the Federal Reserve right now is doing an extensive study of how they should change whether they should change their monetary policy strategy. It turns out, I think, that the issue about changing the inflation target is probably not the right answer, but the way you do the inflation target is a big issue. And in fact, I've argued that the Fed has to basically say that there are times when, in fact, if you've been undershooting the inflation target, you should be happy about overshooting it, because on average, what's key is that on average, you actually should achieve the inflation target. That's a change from what they're doing. The way they do things now is bygones are bygones. Wherever you've been in the past, no worries. We still shoot for 2%. I think they should modify that. But there's been a lot of talk about this. There are reasons why raising the inflation target solves some problems, but actually could create others. And so, to me, Greenspan got it right when he said, what is when we worry about inflation, we worry about it when it starts to affect decisions. And it said, in fact, not having that happen means that firms will focus on what they should focus on.
We have a short time left. I know Mona and David have quick questions. Jump in there, guys.
Oh, yeah, no, I think from our perspective as well, we do think the language around symmetry around inflation makes a lot of sense from the Fed's perspective. It's been running kind of cold for 5 years plus now. Could they let it creep upwards beyond their 2% target for 5 years plus? Absolutely. So I think the inflation metric almost gets taken out of the equation. And then we're back to the others. Economy. They want to continue this expansion, global uncertainty around trade and global growth. So I think those metrics come to the forefront more from the Fed's decision.
David, we have 30 seconds. Quick final comment.
No, I think we also need to add asset prices in here, because the problem is that a policy that keeps inflation stable could well let asset prices go to the moon. And I think it's really important to add that to their considerations here, because I think this policy just pumps up asset prices.
All right. Thanks so much, Frederick, Mishkin, Mona, David. I know you're sticking around as well.
Absolutely.
Well, the Fed consistently mentions the trade overhang on the economy due to the uncertainty of negotiations with China. Let's get to Kayla Tausche with more on that. Kayla?
Contessa, top business executives are also left wondering what the outcome of those talks will be. Earlier today, the Business Roundtable held a briefing for reporters where outgoing Chairman Jamie Dimon gave his views on the trade talks and the cost on the U.S. economy. He said it will take about 5 years to tell whether these tariffs worked, telling reporters, quote, "It's unclear what the results are yet. Tariffs are a tool, not one we would want to use. But I heard from a Chinese official, it actually did bring us to the table. This imbalance has to be fixed. It cannot go on any longer, whatever the economic cost is." He also said he thinks there will be a phase one deal in his personal view that delays tariffs, but he thinks any deal after that is unlikely. And that sentiment is hanging over executive decision-making. A quarterly survey of 140 CEOs showed outlook for hiring and investment falling, even as CEOs expect sales to rise and GDP to grow 2.1% next year. The Business Roundtable's overall outlook fell for the 7th straight quarter, mirroring the Trump administration's hard line on trade during that time, Brian.
All right, Kayla, thank you for that.
All right, so let's now get some final thoughts from David as Mona as we await the Fed Chairman Jerome Powell.
I think
not final thoughts ever, but just on the show. I hope get home safely.
I think we should reckon. We always say uncertainty is rising, but think about it. Today we got more certainty about Fed policy.
We did?
Yes, we did. They are clearly saying they don't want to change rates, and their statement really makes that point. But also this weekend we could have a clearer path towards Brexit. outlined here, if the British election tomorrow, and then also if we have a deal to not go ahead with the December 15th tariffs, that's some more certainty. So we always talk about uncertainty rising. Actually, this is a week in which uncertainty might fall.
Can we not forget, though, I mean, there are major protests going on in Hong Kong, fighting for democracy. The Chinese may come in with a heavier hand. Their currency is sliding. Their economy is getting shakier. I mean, we're not talking enough about that.
Yeah, it's a great point because they have every incentive to come to the table to have some sort of win, some sort of show of progress from their end as well. Yes, we have a political election in 2020 where perhaps President Trump needs that as well, but it is more balanced, and I think that has been shown in the media in the past.
So if we have a wait-and-watch Fed going into 2020, how should investors think about positioning themselves in light of that?
Well, think about where we're waiting from. We're waiting from a point where bonds and cash aren't even matching inflation except at very long durations or taking on credit risk. Therefore, I think you think about equities. The one thing I'd say is look beyond 2020, look to a period where we'll have more trade peace. And if you do that, I do think there's a lot of international opportunity out there also. So I'd overweight equities relative to fixed income, but also for long-term investors, make sure you got that international exposure because it will bounce back.
And I'll just say quickly, I do think prior insurance rate cutting cycles have yielded an environment where risk assets across the board can do quite well. We've seen that already play out to some extent, but we continue to favor equities here as well. We continue to see global equities playing some catch-up next year, so that could be a great place.
And I know everyone's focused on Apple and all the FANG stocks, but let's not. I just want to, in the last couple weeks and months, coffee, some of the commodities have surged. The Japanese market looks like it's finally caught in some fire. You got the European markets doing okay. Brazil continues to hit new multi-year highs. It's not just about buying the FANG stocks.
It's not just about S&P and growth. Having some of that value component makes sense here. If you look historically when PMIs bottom and do start to move upwards, that value sector goes up with it. And so that's, a very real potential going into 2020. And I think the election year can do well also for equity markets broadly.
And David, you said that you need to be invested in international. Are there particular regions that you're?
Yeah, I think emerging markets in general will do better with trade peace. That's what really got hit by the trade war.
David, glad you didn't say Ireland. Thank you. No, David Kelly.
I see.
Guys, thank you very much. Yeah, here we got to go. Jay Powell, let's listen in.
To begin, I'd like to say a few words about Paul Volcker, who, as you know, passed away earlier this week. Paul Volcker served as Federal Reserve Chair from 1979 to 1987. He accomplished many things during his long and distinguished career at the Fed and elsewhere. Of course, he's best known for leading the fight to tame the double-digit inflation that he inherited as chair, thus laying the foundation for the prosperity and price stability we enjoy today. But what is perhaps most admirable about him, more than his many accomplishments, was his character. He believed that there is no higher calling than public service, and he dedicated the lion's share of his life to it. With courage, integrity, and tenacity, he always pursued the policies that he believed would ultimately benefit all Americans. My colleagues and I continue to draw inspiration from his example. Turning to today's meeting, my colleagues and I decided to leave our policy rate unchanged after lowering it a total of 0.75 of a percentage point at the previous 3 meetings. As always, we base our decisions on judgment of how best to achieve the goals Congress has given us: maximum employment and price stability. Our economic outlook remains a favorable one, despite global developments and ongoing risks. With our decisions through the course of the past year, we believe that monetary policy is well positioned to serve the American people by supporting continued economic growth, a strong job market, and inflation near our symmetric 2% goal. The economic expansion is in its 11th year, the longest on record. Household spending has been strong, supported by a healthy job market, rising incomes, and solid consumer confidence. In contrast, business investment and exports remain weak, and manufacturing output has declined over the past year. As has been the case for some time, sluggish growth abroad and trade developments have been weighing on those sectors. Even so, the overall economy has been growing moderately. And with a strong household sector and supportive monetary and financial conditions, we expect moderate growth to continue. As seen from FOMC participants' most recent projections, the median expectation for real GDP growth slows slightly over the next few years, but remains near 2%. The unemployment rate has been near half-century lows for well more than a year, and the pace of job gains remains solid. Participation in the labor force by people in their prime working years, ages 25 through 54, has been increasing, and wages have been rising, particularly for lower-paying jobs. People who live and work in low- and middle-income communities tell us that many who have struggled to find work are now finding new opportunities. Employment gains have been broad-based across all racial and ethnic groups and all levels of education. These developments underscore for us the importance of sustaining the expansion so that the strong job market reaches more of those left behind. We expect the job market to remain strong. The median of participants' projections for the unemployment rate remains below 4% over the next several years. Inflation continues to run below our symmetric 2% objective. Over the 12 months through October, total PCE inflation was 1.3%, and core inflation, which excludes volatile food and energy prices and is a better indicator of future inflation, was 1.6%. While low and stable inflation is certainly a good thing, inflation that runs persistently below our objective can lead to an unhealthy dynamic in which longer-term inflation expectations drift down, pulling actual inflation even lower. In turn, interest rates would be lower as well and closer to their effective lower bound. As a result, the scope for interest rate reductions to support the economy in a future downturn would be diminished, resulting in worse economic outcomes for American families and businesses. Against the backdrop of a strong economy and supportive monetary policy, we expect inflation will rise to 2%. The median of participants' projection rises to 1.9% next year and 2% in 2021. We're strongly committed to achieving our symmetric 2% inflation goal. Over the course of the past year, our views about the path of interest rates that would best achieve our employment and inflation objectives changed significantly as the economy faced some important challenges from weaker global growth and trade developments. As the year progressed, we adjusted the stance of monetary policy to cushion the economy from these developments and to provide some insurance against the associated risks. In addition, inflation pressures were unexpectedly muted, strengthening the case for a more supportive stance of policy. Rather than modestly increasing the target rate for the federal funds rate this year, as seemed appropriate a year ago, we reduced it by 0.75 of a percentage point. This shift has helped support the economy and has kept the outlook on track. The median of participants' projections for economic growth, the unemployment rate, and inflation are little changed from a year ago, aside from a lower inflation projection for 2019. Of course, that is the function of monetary policy, to adjust interest rates to promote employment and price stability in response to forces acting on the economy. We believe that the current stance of monetary policy will support sustained growth, a strong labor market, and inflation near our symmetric 2% objective. As long as incoming information about the economy remains broadly consistent with this outlook, the current stance of monetary policy likely will remain appropriate. Looking ahead, we will be monitoring the effects of our recent policy actions along with other information bearing on the outlook as we assess the appropriate path of the target range for the federal funds rate. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course. Finally, I wanted to note that we've been purchasing Treasury bills and conducting repurchase operations consistent with the plan we announced in December. These technical operations are aimed at maintaining an ample level of reserves and addressing money market pressures that could adversely affect the implementation of monetary policy. Our operations have gone well so far. Pressures in money markets over recent weeks have been subdued. To address possible pressures in money markets over the year-end, we've been conducting term repo operations spanning year-end. We stand ready to adjust the details of our operations as appropriate to keep the federal funds rate in the target range. Thank you, and I'll be happy to take your questions.
Howard Schneider with Reuters. Sorry about that. So I was struck by the sort of disconnect that exists here between the behavior of unemployment and inflation. You seem to have unemployment penciled in here now for 3 years running more underneath the longer run level, yet inflation never really accelerates. So what are we to make of that?
Well, that's what's happening there is the fact that the relationship between resource utilization or unemployment, and inflation has just gotten weaker and weaker over the years. If you go back 50 years, you would have seen that when labor markets were tight and unemployment was low, inflation moved right up. And then as the Fed got control of inflation, the connection got weaker and weaker and weaker to the point where there's still a connection, but it's a very faint one. And what that suggests is that you would need to keep policy somewhat accommodative, and we believe that policy is somewhat accommodative. And we think that that's the appropriate place for a policy to be in order to drive up inflation.
Follow up on that. I mean, it's faint and non-existent, though, it seems to me. So this suggests that really your policy lever, as it exists now, isn't really influencing prices at all. So in that case, what do you do to reach your target?
Yeah, no, I don't think that's right. I mean, the relationship between slack in the economy and inflation is weak, has been weak. The coefficient is something like 0.1, so it's much, much lower than it used to be, but I don't know that it's gone down any more in the last decade. It just is quite faint, but it's still there. I mean, you can see it. If you look at where wages were 3 or 4 years ago, they were running around 2%, and now the whole group of different wage measures that we monitor has moved up to 3 and 3.5%, and that suggests tightening. The same thing is true, but much less true of inflation. The relationship between, in a way, the wage Phillips curve has a higher coefficient than the price Phillips curve does. But we do still see some relationship, and that's what you're seeing in those numbers.
Mr. Chairman, Steve Leisman, CNBC. You've used the analogy to 1998 to describe the rate cuts we just went through. And I'm wondering if we can sort of continue the analogy. Within 7 months of those 98 rate cuts, the Fed took them back and then some. So were those kind of rate cuts the kind that you need to take back? Or are we at a place now where we're at a neutral rate? Take back, I mean, if those risks that you say we're cushioning from don't materialize in the way you think. Or is this now a new sort of steady state for the economy at this rate? This is the right rate for the economy that you see going forward and don't need to take those rate cuts back?
So there's similarities, conceptual similarities, I think, between the two instances during that long expansion, I guess in 95 and 98, when the Fed cut 3 times only to resume raising rates. And the notion just is that the economy needed slightly more accommodative policy, but it wasn't the end of the expansion, right? And that's the same situation we believe we're in here. So we did in fact turn out to do 3 rate cuts. That wasn't in the plan, in any kind of specific way at the beginning. So that's the same. What's different is you have very different structural characteristics in the economy, particularly around inflation. So now, as you can see, inflation is barely moving up, notwithstanding that unemployment is at 50-year lows and expected to remain there. So the need for rate increases is less. And by the way, it's a good thing that we think we've learned that unemployment can remain at quite low levels for an extended period of time without unwanted upward pressure on inflation. In fact, we need some upward pressure on inflation to get back to 2%. It's quite different in 95 and 98 when there were those two adjustments. So I would say similarities and differences.
BIS concluded I did the same thing as Howard. Michael McKee, Bloomberg Radio and Television. The BIS concluded in September that the repo spike was not a one-off confluence of random events, but reflected structural and regulatory issues that could lead to a recurrence. I'd like to ask you if you agree with the BIS findings, and given that we're approaching year-end for the markets, will you be taking any extra steps to ensure that funding is available in the repo and FX swaps markets? There was a report yesterday from Credit Suisse suggesting there's a good chance that we will see disruptions, and one of the reasons they put for it is that the Fed is, at this point, buying only T-bills, and the market wants to sell coupons. Do you have any plans to sell coupons?
So I'm going to take a little step back, and I will get to your specific questions on the year-end and on T-bills. So I guess I want to start by stressing that these are very important operational matters, but that are not likely to have any macroeconomic implications. We decided back in January to remain in an ample reserves regime, and that means we will be setting the federal funds rate, the range for the federal funds rate, through our administered rates and not through active management of the level of reserves. We're committed to robustly implementing that framework, as you can see by our actions. And the purpose of all this, let's remember, is to assure that our monetary policy decisions will be transmitted to the federal funds rate, which in turn affects other short-term rates. We have the tools to accomplish that, and we will use them. The purpose of all this is not to eliminate all volatility, particularly in the repo market. So, taking you back, as you know, we very gradually allowed the balance sheet to shrink. We slowed that gradual pace by half in March, and then we ended it in July. Meanwhile, we had surveyed all of the banks, and particularly the large banks who hold a lot of the reserves, and said, what's your lowest comfortable level of reserves? We got those numbers, we added them up, we added a buffer, and it came out sort of at a level that was well below when we were in September. And yet, we saw actually in September that the markets acted as though reserves had become scarce. So what had happened was that liquidity, which actually existed, didn't flow into the repo market, and that had effects on the federal funds rate. So the question is, why did that happen? And we've been very carefully looking at the reasons why that might have happened. There are payments issues. There have been a number of supervisory and regulatory issues raised. We're looking carefully at those. We're open to ideas for modifying supervisory and regulatory practice in ways that don't undermine safety and soundness, and a number of ideas are under examination there. To go through it sort of in time, we started off really on September 17th with overnight operations. By October 11th, we had created and put into effect a plan. That plan is in effect. It's working. I think for the last couple of months, repo markets have been functioning well. Short-term rates are stable. Markets are functioning. So you asked about year-end. Temporary upward pressures on short-term money market rates are not unusual around year-end. And both our repo operations and Treasury bill purchases are intended to mitigate the risks that such pressures pose to our control of the federal funds rate. We think that the pressures appear manageable, and we stand ready to adjust the details of our operations as necessary to keep the federal funds rate in the target range. Our strategy has been, essentially the key to our strategy is to supply reserves in the near term through both overnight and term repo, and at the same time we're raising the underlying level of reserves through bill purchases. I'll take that now. We've said bill purchases. We've also said that we were willing to adapt our strategy. We're not at this place, but if it does become appropriate for us to purchase other short-term coupon securities, then we would be prepared to do that if the need arises. So, but we're not in that place. It very much looks like those bill purchases are going well, just according to expectations. I mean, the other thing I'll say is that we're in, very regular contact with market participants all the time. We'll be continuing that, and we're prepared to adjust our tactics. We're focused on year end as well, and prepared to adjust our operations as appropriate.
The follow-up to that would be, where are we with the possibility of a standing repo facility?
So on the standing repo facility, as you know, we've actually had a couple of meetings where we've discussed that. I think the standing repo facility is something that'll take some time to evaluate and create the parameters of and put into place. At the moment, what we're focused on is, we're now focused on year-end. I should also mention that after year-end, the sense of it is that as the underlying level of reserves moves up because of bill purchases, as that happens, there will come a time when it will be appropriate for overnight and term repo to gradually decline. We can't know today what the timing of that will be, but that's the way we see it going over time.
Heather Long from the Washington Post. A number of your colleagues have said explicitly that they do not think the FOMC should raise interest rates until core inflation is back at 2%. They think there should be a rule. Where do you personally stand on that?
Well, as I mentioned actually at the last press conference, we think our policy rate is appropriate and will remain appropriate as long as incoming data are broadly in keeping with our outlook. And in order to move rates up, I would want to see inflation that's persistent and that's significant. A significant move up in inflation that's also persistent before raising rates to address inflation concerns. That's my view.
So is this the de facto policy of the committee then? I guess I'm wondering why it's not sort of codified in a statement.
We haven't tried to turn it into some sort of official forward guidance. It happens to be my view that that's what it would take to want to move interest rates up in order to deal with inflation.
Gina. Hi, Chair Powell. Gina Smiley with the New York Times. Just following up on Heather's question. So if you look at the SEP today, it looks like inflation is never overshooting 2% and is only getting up to 2% by the end of 2021, yet rates are increasing in 2021. So I guess how do we square that circle with interest rates increasing before inflation ever really moves up in some meaningful overshooting way?
So I think what you're seeing is you've got a full year of the median being flat, which is, we think, accommodative, modestly accommodative, and inflation not moving up very much, as we've discussed. And that underscores, I think, the challenge of getting inflation to move up. The committee has wanted inflation to be at 2%, squarely at 2% ever since I arrived in 2012. And it hasn't happened. And it's because there are disinflationary forces around the world, and they've been stronger than I think people understood them to be. In terms of those out-year rate increases, what you're looking at rate increases more than a year into the future, and people will have their own explanations for why they do that, but none of us have much of a sense of what the economy will be like in 2021. So I think what may be behind some of that is just the thought that over time it would be appropriate, if you believe that the neutral rate is 2.5%, it would be appropriate for your rates to move up in that direction. I will also say to you that a number of people wrote down, and you can't see this at this level of detail, but today, but a number of people did write down overshoots of inflation as appropriate under appropriate policy.
Brendan Greeley from the Financial Times. Given that inflation, whichever measure you choose, has either sort of remained where it is or not increased over the past year, as you've been dropping the policy rate, what is it that gives you confidence that the Fed has the tools to get inflation back up to target or even overshoot, as you just indicated that some people are considering doing?
Well, it's just that there is still empirically, by many different, by the work of many different analysts, there is a relationship between resource utilization, by which I mean unemployment, and inflation. It's just relatively weak. And by the way, that's not a bad thing. That means that we can run at low levels of unemployment and have a historically good, in some dimensions, labor market without having to worry about inflation. It also means, though, that it's not easy to move inflation up. Now you say, why is there confidence? I mean, I would say there's more humility than there is confidence in this at this point. It's been very challenging to get inflation to be at target. If you look around the world, the United States, of all major economies, has been closest to it, but still hasn't quite been able to achieve it. And I would also point out that this year, which has been a good year for the economy, core inflation is actually running at 1.6%, whereas it ran close to 2% most of last year. So it's a real challenge, and but I think we're using our tools as best we can to meet that challenge.
Nick Timmeros, The Wall Street Journal. So, Chair Powell, I want to ask about the framework review, which obviously entails some kind of debate around allowing an overshoot of the 2% target. And in that context, is merely saying that you want inflation to rise above 2% a sufficient strategy for getting inflation to stay at the target, or would it compel some kind of policy action beyond deferring future rate increases to achieve that outcome, if that's the direction in which the committee goes? In other words, it's one thing to accept inflation rising on its own opportunistically, but if inflation does not materialize, would a change in the framework necessarily make it easier to generate higher inflation?
Well, I think the answer to the question of whether saying it is enough to create credibility, the answer to that is no. And I think you have to back that up with policy that supports the outcome. And that's what we're trying to do. And so the changes that we're looking at to the framework are I think they take all of that on board, but what they are designed to do is to strengthen the credibility of that inflation target, but only if followed by policy. Ultimately, it will take time to move inflation expectations up from where they are, which appears to be a bit below 2%. Will not happen overnight. It'll have to happen over time as credibility is built. The Fed has great inflation credibility, but inflation expectations are anchored at about their 25-year average, which is a few ticks below 2%.
We talked a lot about inflation. Edward Lawrence from Fox Business Network. We talked a lot about inflation. I want to ask you about uncertainty. With the House announcing that they will ratify USMCA and Canada and Mexico signing off on it, do you see that uncertainty easing now so the business investment could pick up? Or are the trade tensions with China just that big elephant in the room where you might not see those business investments pick up?
Well, I did see the news today that it appears there's an agreement to move forward to a vote on USMCA. And, of course, it's not our role to comment on particular trade policies or criticize them one way or the other or evaluate them. I will say, though, that if the deal were to be enacted, then it would certainly remove some of the trade policy uncertainty, and that would be, I believe, a positive for the economy. And I'll say the same thing about the negotiations with China, which haven't reached that point yet. We've been hearing from our people that we talk to, the many people and businesses that we talk to through the reserve banks that wind up being written up in the Beige Book, and they've been telling us all year, for a year and a half really, that trade policy uncertainty is weighing on the outlook. And I do think that, again, without commenting in any way on the process or the content of the agreement, I think that removal of uncertainty around that would be a positive for the economy as well.
One uncertainty bigger than the other is, do you see, not commenting on the deals themselves, is one uncertainty for
I think you can, I think you can see that what's been moving, one way to look at it is what's been moving financial markets. It's been news about the negotiations with China, not so much USMCA. I think the difference between NAFTA and USMCA is smaller than the difference between current, arrangements with China and what's being negotiated.
Hi, Matthew Boesler with Bloomberg. Chair Powell, the Fed policy review this year has largely been discussed in terms of the inflation side of the mandate and the need to shore up inflation expectations. But it seems like the message you've been getting from the Fed Listens events and also something else you've recently acknowledged is that, the Fed has also been systematically overestimating labor utilization throughout this expansion. So I'm wondering if you could talk a little bit about the extent to which the review is looking at the employment side of the mandate as well. Are there any possibilities, for perhaps systematizing a more asymmetric reaction function with regard to unemployment? Thank you.
Yeah. So the focus really is on how to use our strategies, tools, and communications to achieve both sides of the mandate. You're right, though, that we've talked here a lot about inflation, and I think that I think more broadly, over a period of years, many years, we've been learning that the natural rate of unemployment is lower. It's in estimates, not just at the Fed, but broadly among economists, labor economists, have seen that the connection that we can sustain much lower levels of unemployment than had been thought. And as I mentioned, that's a good thing because that means we don't have to worry so much about inflation. And you see the benefits of that in today's labor market. The Fed Listens event are about inflation to a much lesser extent than they are about maximum employment. If you've listened to or attended any of those, the discussion, we always focus on inflation as well, but the discussion is really around what's happening in low and moderate income communities and among small businesses. And I think you get a perspective which we were already getting that from our extensive outreach to community groups and such, but it was helpful to get it in the context of a monetary policy review. And I think that the fact that these communities have such high levels of unemployment and low levels of labor force participation tells you that there is slack out there. And I think that does also inform our understanding of what we mean by maximum employment. And it's been a very positive. I would say that the Fed Listens events have been extraordinarily positive, and they're certainly something we'll repeat. You also see from the business perspective that companies are taking all kinds of measures to look through things on people's resume that would have perhaps disqualified them in other kinds of environments. Training is moving up. You hear just a lot. There are a lot of things going on that suggest that people at the margins of the labor force are being pulled in and being given chances, which is a great thing.
Victoria.
Sorry, if I could just follow up briefly. Is there any way to sort of systematize these insights, do you think, in terms of, we talk a lot about, for example, make-up strategies on the inflation side. Is there anything similar you could do on the employment side?
I think we have kind of internalized, and this isn't news for today. This is something we've been saying for several years. You've seen us moving down our estimates of maximum employment. In fact, it's already understood, I think, that there's more. Even though we're at 3.5% unemployment, there's actually more slack out there, in a sense, and the risks of using accommodative monetary policy, our tool, to explore that are relatively low. I think we know that, and I think the review certainly underscores that. But that's a very important insight.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask more about the repo issues and what you all are doing beyond open market operations. Are you currently, for example, telling examiners not to prefer reserves over treasuries for supervisory purposes? Are you talking to the Treasury Department about maybe reducing the level of volatility in their account at the Fed? And on the standing repo facility, is it that you would be inclined to do it, but you need to figure out the details, or what would kind of drive the decision on whether or not to do that?
So on treasuries versus reserves, we've done a ton of work on that. We've talked to supervisors, and it's interesting. If you look at the banks, they're all over the place on the composition of their buffer. So you have a business model, and that business model suggests what your stress outflows will be, and that suggests what your buffer should be. And you see them making quite different choices. Some of them have lots of reserves and fewer treasuries, and then they change their mind and they switch. So it's not obvious that there's one thing happening there. Notwithstanding that, we've gone out to try to understand that, talking to the supervisors. In terms of the TGA, we have not tried to pull the TGA into this yet. We've taken it as exogenous. I don't know that at some point we won't have those discussions, but Treasury, we want Treasury to be able to have the cash that it needs, and then we're essentially taking that as exogenous to our work. There may come a time when we talk about that, but we haven't done much of that. Standing repo facility. So your question on that is, what are we thinking about it? What are we? I think we are more focused, frankly, on the bill purchases, the year end, and also the review of supervisory and regulatory issues that we're digging into, and because we think these are structural things, right? Where you could, without sacrificing safety and soundness, just allow the liquidity that is already there to flow more freely, perhaps by making fairly straightforward, non-controversial changes. And we think there is some of that, and so we're working hard and fast. But those are things, if they take rule changes, it'll take, a notice of public rulemaking, it'll take 3 months and things like that. Those things take time. These things that we're working on now, though, like, going through year end with the overnight facilities and the bill purchases and the term repo, those are things that we have to do right now and are doing.
Hi, Chris Rugaber at Associated Press. I wanted to ask, the only change in the statement was a drop in the reference to uncertainties around the economy. You seem very confident, or it implies there's a lot of confidence that those uncertainties have gone away. What caused you to make that change for this statement? What were you looking at that seemed to be so much lower?
We did actually, if you look at the statement, you'll notice that we we did call out global developments and muted inflation pressures later in the statement. And why did we do that? Those are the things that we've been monitoring all year. We've put now in place policies that we think are appropriate to address those things. So we're not revisiting that. But those are just key things, and they haven't gone away. So we thought it was appropriate to mention them there. Still subject to the idea that for us to change our stance, we would want to see a material reassessment of the outlook.
Well, just to follow real quick on the material reassessment aspect, are you worried that has set too high a bar for potential cuts next year? We were talking about rate hikes, but no Fed policymaker seems to foresee any cuts next year. Some economists do. Does a material reassessment mean you need to see data actually worsen? Does it reduce your ability to act preemptively the way arguably you did this year?
So, one thing that we're mindful of is that we've cut rates 3 times since July. That's 75 basis points worth of cuts. And we do believe that monetary policy operates with long and variable lags, and that it'll take some time before the full effects of those actions are seen in the economy. So that'll take some time. So that's one reason to hold back and wait. And we think we took strong measures. In fact, if you look at more broadly at the Treasury yield curve, it has moved more than 75 basis points. So you've had quite a significant move in the direction of higher accommodation. In terms of what is material at the end of the day, I would just say whether or not a change in the outlook merits a policy response will be a collective judgment of the FOMC. There isn't any single factor that will determine our decisions. We'll look at a full range of data and other information bearing on the economic outlook.
Okay, Scott Horsley.
Hi, thank you, Mr. Chairman. Scott Horsley from NPR. You started out by talking about Paul Volcker, who obviously cast a long shadow. I wonder if, in hindsight, that shadow was too long, and if in the decades since his tenure, and in particular last year, if the Fed was too quick to raise interest rates to attack an inflation boogeyman that didn't materialize.
This wouldn't be my response will not be about Paul Volcker, but although you started with Paul Volcker. So if you look back at 2018, I'll just take you back to the beginning of 2018. We had an economy growing at 3%. We had inflation at 2%, and we had $1.5 trillion worth of stimulus arriving, and the federal funds rate was 1.4%. So it wasn't that. So we moved policy up during the course of the year. We never got policy even at the level of what we thought the neutral rate was at the time. So there was no sense of it being restrictive. We took steps to make it less accommodative, and that seemed to be the right thing. It still seems to me to be the right thing in hindsight. The idea that we were trying to slow the economy down, we were really just trying to get near neutral. And even with the last rate increase a year ago, we were still meaningfully below the median estimate on the committee of what the neutral rate was. So policy was always accommodative during the course of that year. I think what's happened is obviously the facts on the ground have changed. You saw the global economic slowdown begin in the middle of last year, gather force, and then continue to go on this year. So you've seen a continual weakening. Just look at the IMF's forecast of growth from the spring of 2018 and compare them to now. You've had quite a significant. That does affect us. I think also the trade situation was just beginning in the middle of 18, and I think it has had. I think there'll be very, very wide range of estimates of the effect, but I think it's had a meaningful effect on output just through the uncertainty channel and to a lesser extent through the tariff effects. And again, that's not to make a judgment. It's not up to us to make a judgment about that. So that would be my story.
Chair Powell, Donna Borak with CNN. To follow up on Edward's trade question, could you talk about what you would imagine the economic effect would be if negotiations with China were to fall apart, and how the Fed might be able to support the economy in that event?
I wouldn't want to speculate on a hypothetical. I would say we'll just have to see. We look at a range of factors, and we as I've said before, we try to look through the volatility in trade news and trade negotiations. We try not to react. We can't react. Monetary policy is not the right tool to react in the very short term to volatility and things that can change back and forth, as this has happened, as is probably typical of a large, complex negotiation. In terms of, I don't want to get into hypothetical outcomes, though, if that's all right.
I'm just wondering, you met with the president last month. Did you have any advice for him when it came to this? And did you express some concerns about potential volatility and the impact of the economy given all this?
I'm going to stick with my predecessor's longtime practice of not discussing private meetings with elected officials or other officials, really. But thank you.
Thank you. Virginie Montet with Agency France Press. Yesterday, Democratic leaders in the House have launched an impeachment process against the president. Have you mentioned these developments within the committee today as potentially presenting some risk for the confidence in the economy?
No, we have not. We don't consider things like that.
Mike Darby with Dow Jones Newswires. Does the Fed's dot plot still serve a useful communications purpose, or do you feel that it might be time to retire it or change it in some fashion?
I think properly understood, it can be useful, but that's been a challenge. I think properly understood to me means looking at what it is and not at what it isn't. And what it is it's an expression of the thinking about individual committee members about appropriate monetary policy and the path of the economy. Remember that we write all that down and we send it in and it gets compiled, but we don't discuss it at the meeting and we don't negotiate a plan. There's no agreement, there's no plan. And I think particularly at inflection points, it's hard to convey the reality, which is that policy is always going to depend on the economic outlook and changes in the economic outlook. And when the economic outlook is changing, the dots they're just not a consideration. We're going to do what we think is the right thing for the economy. And if the dots that we did 6 months ago or 3 months ago don't agree with that, that's not even in the conversation. So it's more, but it can be useful. And I think, but as I said, it's been a challenge. And so I do like to say, if you focus too much on the dots, you can miss the broader picture.
Greg Robb from MarketWatch. Chairman Powell, many people seem worried that the framework that you guys are working on is going to be, the results are going to be less rather than more. People keep coming back and asking why you took off like a 4% inflation rate off the table, even when it started. I mean, as you said, if going around the country for all the listen events, I don't think I heard anybody worry about a 4% inflation rate or think that higher inflation rate was going to be a problem. So where does that concern come from? Is it members of Congress that have said this?
No. So let me say we've been working on this all year, and we're just at the stage where we've had a really interesting discussion about the various tools that we have at the October meeting. At this meeting, we talked about the way monetary policy affects different groups in the economy. So we talked about the Fed Listens events and some very interesting research. So we're just getting to the stage where we're looking at conclusions. What do we take away from all this? And those things, many of those things would wind up as changes, if you will, modifications to the statement of longer run goals and monetary policy strategy. I think that process will take until the middle of the year. But we want to approach it very thoroughly and very carefully. And that is, in effect, that is our framework document. And I wouldn't prejudge. No one. I believe we will be able to reach a successful conclusion and make meaningful improvements. I do. In terms of 4%, so I think it's premature for people to be saying that this isn't going anywhere. And if you define going anywhere as a 4% inflation target, let me talk about the 4% inflation target. So I'll go back to the point that just saying words is not itself credible. So I think if you said we're raising the inflation target to 4, what would be the effect of that? I mean, where's the credibility in that really? You haven't been able to get it to 2. So I think you need to lower your sights a little bit. I also think is 4%. You'd have to ask the question: is that really, price stability? Is that really price stability? Is that within our legal mandate? I mean, I think it's a fair question. So, I think I'd like for this review to come out with a set of positive results. Meaningful improvements. It doesn't mean it has to solve every problem going forward. We want to have this be a successful exercise where we meaningfully improve our monetary policy framework. These things don't tend to move in a lurchy way. They tend to evolve. But I think, and if we do this then in a few years again and again, and things like that, then then at least we're moving in a good direction. And I think we will be. I'm confident we will be.
Don Lee with the LA Times. Chair Powell, you've had a busy year, and I'm wondering, as you look back, what things you might have done differently, and whether there are any lessons that you would take into next year.
Well, I have to say my total focus is on right now and getting policy right and thinking about next year. Thinking about what's the economy going to be doing. I like where we are in policy. As I mentioned, I think our policy stance is appropriate and likely to remain so, as long as the outlook is broadly like this. I mean, it's too long of a question. I don't know how to get after that. There's a lot of learning that comes into from the economy every year, and in the way we do our jobs, and we're always going to be trying to learn lessons.
I mean, are there any particular surprises, whether it's the economy or how markets or financial things have?
Well, I didn't obviously, didn't see, and I don't think anybody saw coming the challenges that we faced this year. I think they were a surprise. I think toward the end of 2018, there was still a sense the economy was growing at around 3%, and didn't expect to face the challenges. But I think we did face them, and I think I'm pleased that we moved to support the economy in the way that we did. I think our moves will prove appropriate. And again, I think both the economy and monetary policy right now, I think, are in a good place.
Nancy Marshall-Genzer from Marketplace. Chair Powell, why aren't we seeing stronger wage gains? Wages are growing more slowly now than they were toward the beginning of the year. Why is that?
Well, wage gains have moved up a bit. If you look back 3-4 years, you'll see wages were growing around 2%. Now you see them moving up, more 3.5%. So why aren't they growing higher at a faster rate? And it's a couple of things. I think there are a range of explanations. One would be that productivity has just been low. So wages should go up to cover inflation and productivity. Productivity has been low, and that is very likely to be holding back wages. I also think there are other possible potential explanations, such as globalization can be the idea that you can manufacture or even provide services anywhere in the world to anywhere in the world. I think that hangs over the wage setting process and everywhere pretty much. You don't see there isn't the kind of traction in the wage market that even in a tight labor market. Another thing is though that the labor market may not be as tight as we had thought it was, I think there are many possible explanations. I will say though, if you look for example at non-supervisory employees in the labor report, their wages are going up at 3.7%, and so you do see, and wages are going up the most for people at the lower end of the. That's been true for the last couple of years, lower end of the wage spectrum. So you do see wages moving up. They're not moving up at very high rates. And again, at the end of the day, that probably has most to do with productivity.
Hannah, could I ask a quick follow-up?
Just as far as the market not being as tight as you thought, are you saying there are still more people on the sidelines who could join the labor force.
Yes, and I would also say that if you ask people, and we did ask people, what do you think the natural rate of unemployment is? People were writing down numbers in the 5s, and then they were writing down numbers in the 4s, and now unemployment's been in the 3s for a year and a half, and we still see wage inflation, as you mentioned. The level of wage inflation has actually moved down, although there may be compositional effects in that number. That may be to some extent about younger workers coming in at lower wages than retiring workers. But that shouldn't have much of an effect, actually. So why is that? It may just be that there's more slack in the economy. And I think we are seeing that. We're seeing, really it showed up through higher participation. For many years, we've thought that there's a trend decline in participation. Notwithstanding that, against that trend, we've seen prime age participation moving up pretty steadily over the last 2 or 3 years. And that's a very positive thing, but it does sort of provide more labor supply, meaning a less tight labor market.
Hi, Hannah Lang with American Banker. Thanks for being here today. I just wanted to ask about the Community Reinvestment Act, since the FDIC and OCC may potentially join together for a proposal without the Fed. Are you concerned that this might cause confusion, and how would the mechanics work if this proposal is finalized without the Fed?
So, we think the CRA, we know the CRA is a very important law, and we're strongly committed to the mission of ensuring that banks provide credit throughout their communities, particularly addressing the needs of low and moderate income households and neighborhoods. We also think it's time for modernization. We've thought that for some time, and we worked very hard to try to get aligned with the OCC really on a proposal. And my hope is that we can still do that. I don't know whether that'll be possible or not. We'll just have to see. And if we can't, I'm not sure what the path forward would be. We would certainly not want to create confusion or sort of tension between the regimes if they do turn out to be slightly different regimes. So that's something I hope we don't have to face, but we will if we have to.
Hey, Brian, for the last question.
Hi there, Brian Chung with Yahoo Finance. So before the July meeting, you said something kind of colorful. You said to call something hot, you would need to see some heat, referring to the labor market. So to expand a bit, I guess, on Nancy's question, it seems like the wage Phillips curve has been pretty well explored already. But what would you need to see to call the labor market hot in that case? Would it be a some sort of change in either the headline number of gains or in the unemployment rate?
Really, wages. I mean, there's so many other measures that suggest that the labor market I'd like to say the labor market is strong. I don't really want to say that it's tight. Someone asked me a question about a hot labor market. That was in the Humphrey Hawkins hearings. So I'll say that the labor market is strong. I don't know that it's tight because you're not seeing wage increases. Ultimately, if it's tight, those should be reflected in higher wage increases. So it does come down to that. We look at countless measures of labor market, labor utilization, and there's so many, it's too many to count. But the one that is kind of suggesting that it's a healthy number, that the sort of 3.1% average hourly earnings number is a decent number. 3.7% for production non-supervisory workers is more healthy. Ultimately, though, we'd like to call it hot, you'd want to see heat. You'd want to see, higher wages.
Thank you.
Thanks.
Good afternoon. Welcome to the closing bell, everyone. Chair Powell just finishing up his press conference after the Fed, of course, kept rates on hold. Let's check in on where the markets stand as we are. The S&P near the highs of the session, up about 0.25%, while yields, the 10-year at 178, near the lows of the session. So the market taking today's press conference decision slightly positively, slightly constructively, slightly devishly, but I say slightly with emphasis because, in perspective, the S&P is only fractionally higher, and the 10-year yields moved from 184 at the open down to 178. Not huge moves in the context of things.
We're going to go through it all with a very big lineup of guests ready to react to the day's Fed decision. Josh Brown is with us, David Zervos, Paul McCauley, and Michelle Meyer. They're going to break down the market action for us. Plus, we'll ask former Minneapolis Fed President Ariana Kosher-Lakota and former Fed Governor Sarah Bloom Raskin whether today's decision was the right one for the economy. But let's go first to Josh Brown. He's CEO of Ritholtz Wealth Management, and he's with us for the full hour. So, Josh, kind of as we expected, but perhaps that's a good thing here from where we sit.
Courtney, if I could sum up Chairman Powell's remarks just now, one word: riveting. Just, oh my God. I am just, look at my knuckles, they're still white. I am just at the edge of my seat. Look, there's a character in an Isaac Asimov novel called Foundation. And in one scene, he goes to a foreign planet, spends the whole week meeting with everybody, and they're recording every second of him. They have cameras, they have mics. And then they go and decipher what it all means. And it turns out he had all these conversations with all these top dignitaries and officials and said absolutely nothing. And I think that's actually good that we're back in that realm with our Fed chair. It's a throwback in some respects. There really isn't anything to say. So he addressed the plumbing, the money market fund issue. We heard about the funding markets, the short-term markets. Great. There really wasn't much ado about that lately anyway. And then they put out the 2020 outlook, which 2% growth, 3.5% unemployment, which is down from what they said in September, 3.7. There's not really anything else to put into a headline here. And I'm telling you, the market is fine with that. It's perfectly fine. We're all good.
The market is fine indeed. Flat Dow, higher S&P, higher NASDAQ. NASDAQ leading it up 0.4%. The dollar is down 0.4%. Let's get more reaction and bring in all of our panel. Paul McCulley, former chief economist at PIMCO. Michelle Meyer, head of U.S. economics at Bank of America Merrill Lynch. David Zervos, chief market strategist at Jefferies. Good afternoon to you all. Paul, I'll start with you. The sense that the market seems to be taking, are they right to do so, is that the scope now, the hurdle to see another either rate cut or a rate hike is incredibly high from where we stand today.
Yes, it is. That's what Mr. Powell said last time, and he said it even with fist on table this time. It takes something material to get them to move. At the same time, I think he stressed, he did a really great job of this, that it's asymmetric in that the hurdle for easing would not be terribly high because they really do not want to see the economy weaken from here. But the hurdle for tightening would be exceedingly high because they actually want inflation higher. He was most explicit that he's been, since he's been in the job, that he wants inflation up, damn it.
He sure does. Michelle, we also talked a little bit about that repo market and did a fairly good job of explaining the Fed's action, what they did, even if we don't really know the entire reasoning for the moves that we saw there. What did you make of his commentary and what's expected going forward for their actions to be continued?
So I think what the Fed is trying to do is to be very clear to markets that they have this under control. At least that's what they want to present. And I think that Jay Powell did that today as well. That said, we won't really know until we get through a certain number of key events, particularly what happens at the end of the year. And a lot of market participants remain worried that maybe the Fed doesn't quite have a handle on it, indeed. They have the tools in place. They have the repo facilities. They are expanding their balance sheet for technical reasons. They're adding reserves in the system. They're talking about the move towards organic balance sheet expansion, which ultimately is something that they're going to need to do. But I think that, he talked around the issue. He didn't give too many specifics. And I think that was partly intentional. He also doesn't want to give specifics in this setting per se, because he doesn't want it to appear as though it's a form of monetary policy. It's plumbing. It's technical.
I think everything he does is very intentional. Everyone stay with us right now. If you're just joining us, we're going to catch you up on some of the key things that Fed Chair Jay Powell said in today's news conference.
My colleagues and I decided to leave our policy rate unchanged after lowering it a total of 0.75 percentage point at the previous 3 meetings. Our economic outlook remains a favorable one, despite global developments and ongoing risks. Business investment and exports remain weak, and manufacturing output has declined over the past year. We expect inflation will rise to 2%. The median of participants' projection rises to 1.9% next year and 2% in 2021. If developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course. Inflation is barely moving up, notwithstanding that unemployment is at 50-year lows and expected to remain there. So the need for rate increases is less. After the last couple of months, repo markets have been functioning well. Short-term rates are stable. Markets are functioning. We think that the pressures appear manageable, and we stand ready to adjust the details of our operations as necessary to keep the federal funds rate in the target range. and trade negotiations. We try not to react. We can't react. Monetary policy is not the right tool to react in the very short term to volatility. I think both the economy and monetary policy right now, I think, are in a good place.
Let's get reaction now from CNBC's Steve Luseman, who, of course, was in that room today. Hi, Steve. What do you make of Chair Powell's press conference in general?
Well, I mean, I think that he gave us some meat around the bones of this new regime that the Federal Reserve is in, which is this holding pattern that it's in. And I think I asked a pretty logical question, which is, okay, you told us that the rate cuts were like 98. So how much further can we push the analogy? I pointed out that in 7 months after that, the Federal Reserve began hiking rates. And I said, are these the kind of cuts you take back, or are we at a new steady state? And he was pretty specific. These are not the kind of cuts you take back. I think that even when the risks of trade were to go away, or even global economic weakness were to go away, I think Chairman Powell feels like we're at a rate that he can still maintain, doesn't have to take back the insurance. And I think that's an important thing for the market when we try to, in this new regime we're in, trying to game out, well, how long is the hold and what is the potential next move? I think McCulley had it absolutely right, which is the asymmetry, the unfairness, if you will, of the new policy, which is that it'll be very easy to cut and much harder to hike from here. And I think that's the bottom line of what Powell told us. He thinks he has the repo market under control, and that we shall see in the next several weeks.
Steve, stick with us. We're going to continue the discussion, of course. Josh, by the way, I thought you looked even more riveted during the montage just now.
Yeah, it was the music, though.
It was the music.
Yeah, I do love a good sound over tape.
I agree, but particularly when the content is also so profound.
Yeah, you know what's interesting? You know what's interesting to me? One of the reporters, I forget who it was, just asked Chairman Powell about where's the wage growth? Like, why is it not accelerating through year end? Why did it seem to be faster early this year? I feel as though we need to have this acceptance that the nature of work itself has changed, and the tools we're using to measure things like wage growth and the labor market and participation, they're from the 60s. Like the flexibility of the U.S. worker, the ability to take on different jobs at different times, it doesn't all compute the way you might like to see it. I know there's some realization of this, but maybe less on the media's part. The Fed can't solve that. In addition, you've got this massive generational changeover. You've got boomers retiring at the top of the income scale, and who's replacing them? 73 million millennials in the workforce, joining the workforce. They're coming in at entry-level salaries. That is not, so if you follow one person and their trajectory, you see them getting raises. If you follow it in the aggregate, you will not see quite the same velocity of wage gains that you would expect at this stage in the cycle. So I think we just need to understand, in many respects, we're using old tools to look at a new economy, and you won't always see the data you expect after rates having been this low for this long.
David Zavos, wanted to bring you into the discussion as well, and in particular what you think about the potential pressures on the dollar going forward, because it seems pretty clear we're not going to get a rate hike anytime soon from the Fed. It's plausible now, perhaps, that the next rate hike comes from somebody else, ECB, Bank of England, or Bank of Japan. The rate in absolute terms will still be well below the Fed, but is it plausible that that now happens?
Well, I really don't think we're looking at rate hike stories for Europe, Japan, certainly Japan, or the UK with all the, even after the election. I think that's probably a more far-fetched story. But I mean, look, we've had 3 rate cuts. We've had a significant increase in the balance sheet and a commitment to that. And the dollar is still not that far off of its, multi-decade highs on a trade-weighted basis. So for all the people that, and there are a lot of people out there that really do want to sell the dollar on this more dovish outlook, it's kind of not working as well as people would have hoped, which tells you that there is some underlying dollar strength out there or some shorts in the dollar. And I think the repo market tells you that people are kind of short dollars. They need to borrow them, and the rates they're willing to borrow them at go up in these spikes. So we borrowed a lot of dollars globally during the QE period at very low rates, particularly outside the U.S. And there's a lot of people who might be struggling to pay those dollars back, and there's demand for them. So I'm not averse to sort of some short dollar strategies, but I don't think it's a great trade. I think the trade for this coming year, 2020, is really a kind of a modified version of what happened in the mid-1990s, which is we got the soft landing after the rate cuts, the equity markets took off, and the only difference is we're not going to get the fixed income sell-off that we got in, say, 96 after the 95 rate cuts. Because, as Chair Powell said, this is not the same story as the 90s. This is a very different inflation story, and a Fed which is committed, as Paul McCulley told us earlier and Steve reiterated, the Fed that is committed to driving inflation higher. That was not the case in the 1990s. And it's a very, very asymmetric Fed reaction function. That was the message today. And actually, I think it's a really important message that many in the market have not fully absorbed.
David, you were talking about the trade, but let's talk about trade in another sense. The chair also said, look, monetary policy is not the appropriate way to react, at least in the short term, to changes in fiscal policy, but the two have to be much more intertwined today than perhaps they have been in recent years. We don't know what's going to happen on December 15th. How do you think that the markets are interpreting what the Federal Reserve is playing out in its own scenarios for the trade policy?
I think, look, trade policy, you can put that through the Fed FRB US model, and you can say, look, it's gonna contract demand. It possibly has some price pressure increases in the short term, although the aggregate demand fall is going to probably negate those. And it's generally a slower growth story that comes out of it. And then there's feedback effects if your partners retaliate against you. So they can do the scenarios. They've done the scenarios. I just think that they're not going to come out and tell you, hey, we're explicitly reacting to trade. It's been a factor in every meeting. They discussed that there's headwinds, and they're considering them, just like there were Brexit headwinds, and just like there were tailwinds from fiscal stimulus that we saw announced last year, and that was part of the reason they were raising rates. So all of these go into the Fed reaction function, and I think the Chair Powell is specifically trying to get away from this idea that if the administration does X, the Fed will do Y, and in terms of either fiscal policy or trade policy, because it just becomes too political, and then the Fed gets itself into a bind. I think they want to keep it at a higher level. They do it in the background, but they're not going to talk about it so explicitly.
Michelle, what did you make of the way in which the Fed chair addressed 2 or 3 questions that he got, which is to say, if today's and this year's policy was the correct decision, does that mean that your policy last year was wrong?
I thought that was a really interesting discussion because Powell did push back against this idea that policy was too restrictive. He said at the time policy looked correct. The facts have changed. The outlook has changed. And that's the reason that they adjusted policy. But I think it might be more than that. I think what they realized at the end of last year is that maybe they went a little bit too far in terms of balance sheet reduction. Maybe they went a little bit too far in terms of rate hikes, and they had to pull it back a little bit. So I think part of their pivot early in the year was, yes, the fundamentals were shifting, but the market shifted really quickly. And part of the reason I think the market shifted had to do with monetary policy potentially being too tight. He didn't acknowledge that. He adamantly suggested otherwise, which I thought was really interesting that he defended their policies to that extent.
Steve, jump back in.
The Fed didn't want to own that 20% decline last year. They didn't want to take direct responsibility for it.
Understandably.
Yeah.
Steve?
I mean, I understand what the chairman was saying, and I remember at the time covering that time period where it was 3% growth, $1.5 trillion of stimulus, and it would have been probably not good monetary policy at the time not to react with a rate hike in that context. It seemed like the right way to go. I would like to point out for the Zervises and the McCulleys of the world, and I thank Conrad de Quadros for this, who you guys both know, points out the inflation picture when the Fed started to hike back in 99 was perhaps not as different as what the chairman suggested it to be. It was still in the low 2s, same place. And I think what's different now, guys, is the political atmosphere, both in the markets and in Washington, which is that nobody out there is haranguing the Fed for being too low. He's got the political support of Democrats and Republicans, and there's nobody in the bond market that's saying, Mr. Chairman, you had to protect me from inflation. But in actual numbers, the inflation level was not a whole lot different when the Fed started taking back those insurance hikes in 98 than it is right now.
And Paul, that was really where you were focused. I was watching you watch the press conference, everything he had to say about inflation and what Powell was looking for going forward.
Yeah, it's profound how much the Fed has changed in accepting and embracing the victory over inflation. I thought it was very appropriate that he gave a very loud and kind comment about Paul Volcker, who started the war against inflation. And we won that war a long time ago. I think Steve was right on the data on that. And the Fed now is officially declaring victory. We won the war, and effectively, Mr. Powell saying it's time for a peace dividend paid to labor. He really wants labor to get its fair share of the economic pie, and he's ecstatic that there's more slack than he thought in the economy, say 2 years ago. So from the standpoint of making mistakes, sure, I thought there was less slack than there is. That's a wonderful mistake. I found more slack. He is a principled populist.
It is pretty amazing that we're still finding workers in this labor force when we're sitting at these 50-year lows for unemployment. Thank you all for joining us. Paul McCulley, Michelle Meyer, David Zervos, and Steve Leisman. Great job down there in Washington, Steve.
We've got 22 minutes left of the session. At the moment, we're up by 13 points on the Dow, so we're pretty close to the highs of the session. It's about 0.3% for the S&P 500. Coming up, we've got your last chance to trade. Josh, looking at one name that's down more than 40% year to date.
Plus, former Minneapolis Fed President Ariana Lakota and former Fed Governor Sarah Bloom Raskin will join us with their take on today's Fed decision. And as we head to break, here's a check on the bonds following the Fed decision. The 10-year sitting right around 1.7% here. Closing bell is going to be back right after this.
The Bond Report. Smart sports wagering talk is now on TuneIn. This is Brett Musburger. The Better Network is now on TuneIn. Search BETR. Be better informed. Be better prepared. And remember, cash and tickets is what it's all about.
Hey, NFL fan. Can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught. It is in for the right side for the touchdown.
Search NFL today.
This is not a commercial. This is a reminder. With TuneIn Premium, you could be listening to more music commercial-free. Get over 45 commercial-free music stations. Visit TuneIn.com/premium to upgrade.
From ESPN and the award-winning producers of The Sterling Affairs comes the latest season of 30 for 30 podcasts. 4 brand new stories of espionage.
He wanted this team to be the Barcelona of women's basketball.
Resilience.
I started to scream. I tried to get away.
Corruption.
It's the culture of win at all costs.
And rebirth.
How will we ever rebuild it?
30 for 30 Podcasts, Season 6. Listen now to 30 for 30 Podcasts on TuneIn.
Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app and see the latest editions under the Your New Episode section. Happy listening.
To LeBron, slam dunk.
The NBA is on TuneIn Premium. Each week, TuneIn picks an NBA game you just can't miss. The Miami Heat are taking their talents to Texas to take on the second-year phenom, Luka Doncic, and the Dallas Mavericks.
Bulls back trying to make it 11-2.
This Saturday, the Miami Heat are at the Dallas Mavericks. Tip-off is at 8:30 p.m. Eastern. Search NBA on TuneIn to follow your favorite NBA team today.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip Bayless.
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
On the goal line, scores! It takes it home!
fans, the 2019-20 NHL season is here.
Here's Pietrangelo, he scores!
And you can hear the action live on TuneIn Premium.
Gonna move, hit a shot, he scores!
From regular season action to the All-Star Game and through the Stanley Cup in June. Hear the home and away call for every game, for every team live. At home or on the go, never miss a game with the NHL on TuneIn Premium. Upgrade today.
First came Market Zone, and now we're debuting the Closing Bell Big Board. On top of the board, you'll see the major averages trading into the close. Below, we're highlighting some of the biggest movers on the day. Today, we're also keeping a close eye on Fed-sensitive areas, as well as shares of Lululemon. That stock reporting quarterly results after the bell. As you can see there, a nice snapshot of all of the key factors today, some macro stories and a couple of those individual micro stories.
Yeah, Lulu shares up more than 2%. They've been up more than 90% year to date. I mean, people expect big things out of this report. So any sign of weakness or pulling back in any of these growth areas, I think could be an opportunity to sell because the gains have just been so significant in shares of Lulu. So we'll find out more after the bell.
Definitely a tough setup.
Okay, here we go. We got about 17 minutes left to go. Josh, what is your last chance trade going into the bells?
So today, on a very special last chance trade, I'd like to talk about Macy's. This is the worst performing stock in the S&P 500 for 2019, assuming things stay around where they are. And I typically don't get involved with stocks on the 52-week low list, but I think there's a really unique and interesting setup here. This is a stock that essentially has been finding support at between 1440 and 1460 pretty much all year long. That's where it tends to bounce from. That is exactly where I would place my stop, or just below. And then as far as a long opportunity, you got a gap up there at 19. So I think you're risking 9% to make 21%. Now, if you think about Bed Bath & Beyond, here's a stock that in August was at $7.50 a share. They were saying all the same things about that stock that they now say about Macy's. No way to win, completely screwed company. That stock has doubled. And what has changed fundamentally for Bed Bath & Beyond? Very little, if anything at all. So sometimes when you have a stock as despised as Macy's is right now, you really don't need anything great to happen. You just need the bad news to stop. Now, one area of caution I'd give you really quickly here. There's a 9% yield. I do not think that yield survives. There is a camp that says, you know what, they can keep the dividend and just cut CapEx, meaning close underperforming stores or get rid of excess inventory. They have a lot. That's not smart. I actually think this company has no business paying a dividend, anything like that. It's not even close to being comparable with the group. They should reduce it, and what they should do instead is focus more on how they're going to modernize the app, the website, and do omni-channel the way Best Buy has done it, the way Target has done it. Look at the charts of some of the other retailing giants. Macy's has to figure out what they have figured out, and they can. So I think you take very little risk here. Use your stop loss. You could have a really nice risk reward, and I would put that trade on if I were inclined to look for a really hard hit name.
This is going to be a good one to watch after the holiday season. We're going to hold you to this last chance trade.
Macy's flat today, down sharply this year, trading at about a 6 times PE, incredibly cheap. We've got 15 minutes left until the close. We're just higher on the Dow, up about 1/3% for the S&P and the Nasdaq. Up next, uninterrupted coverage of the final minutes of trade will take you inside the market zone when Closing Bell returns.
MSNBC is on TuneIn. Get up-to-the-minute coverage on news and events from around the world with MSNBC's live 24/7 station on TuneIn. At home or on the go, stay up to date on the latest news and political trends with MSNBC's full lineup of shows, including Hardball with Chris Matthews.
Hi, I'm Chris Matthews. Thanks for listening to MSNBC on TuneIn.
And The Rachel Maddow Show. Plus, when news breaks, MSNBC has you covered with live updates, expert analysis, and more. Search MSNBC on TuneIn today.
To LeBron, slam dunk.
The NBA is on TuneIn Premium. Each week, TuneIn picks an NBA game you just can't miss. The Miami Heat are taking their talents to Texas to take on the second-year phenom, Luka Doncic, and the Dallas Mavericks.
Pulls back, trying to make it 11-2.
This Saturday, the Miami Heat are at the Dallas Mavericks. Tip-off is at 8:30 p.m. Eastern. Search NBA on TuneIn to follow your favorite NBA team today.
This is not a commercial. This is a reminder. With TuneIn Premium, you could be listening to more music commercial-free. Get over 45 commercial-free music stations. Visit TuneIn.com/premium to upgrade.
Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted!
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught. It is in for the right side for the touchdown to Keenan.
Search NFL today.
Hey, tune in listeners. Steve Kornacki here from NBC News. I want to tell you about a podcast I'm hosting called Article 2, Inside Impeachment. It's dedicated to bringing you the latest developments on the impeachment inquiry into President Trump. Every Monday, Wednesday, and Friday, I talk to NBC News reporters who are closest to the story to break down what's new, what matters, and what it means for the 2020 election. Search and favorite Article 2, Inside Impeachment on TuneIn.
A lot of people aren't aware that TuneIn lets you listen to the same terrestrial stations that you pick up on your FM AM dial, except you can hear them from anywhere. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
On the goal line, scores! It takes it home!
Hockey fans, the 2019-20 NHL season is here.
Here's Pietrangelo, he scores!
Hear the action live on TuneIn Premium.
Gonna move, and a shot,
from regular season action to the All-Star Game and through the Stanley Cup in June. Hear the home and away call for every game, for every team live. At home or on the go, never miss a game with the NHL on TuneIn Premium.
Upgrade today.
Welcome back. 11 minutes left in the trading day. We are now in the closing bell market zone. Commercial-free coverage of all of the action going into the close.
CNBC senior markets commentator Mike Santoli. He's here to break down the crucial moments of the trading day. And today we've got Josh Brown from Ritholtz Wealth Management. He's sticking with us through the market zone as well. Let's kick things off with the markets. Stocks are higher, but just marginally so for the major averages. The Dow is only higher by about 1 point here, and the S&P 500 is hanging on to about 0.2% gain after Jay Powell's decision to leave rates unchanged. Mike, we saw yields move up briefly initially, then they fell. The dollar weakened. Overall, though, largely as expected, would you say?
As expected, obviously, in terms of the non-move on rates. I do think that the message from Powell was a little more dovish than many probably were prepared for. Maybe that explains long-term yields kind of sagging a little bit, and the dollar is down significantly. The stock market is quietly bid, actually. It's kind of gained traction. I think if you didn't obviously have this kind of trade quasi-deadline out there in a few days, you might see the market a little more kind of running to the upside a little bit, but just based on how you're seeing, more stocks up than down. So hard to really argue with it. We're just a fraction below the all-time highs at the moment.
Now, the head of the FAA spoke out about Boeing's 737 MAX today. Let's get to Phil LeBeau. Phil.
Wolf, we're here on Capitol Hill. The hearing that was focused on the FAA and the 737 MAX has just wrapped up. Most of it involved members of Congress grilling the head of the FAA about the process of certifying the MAX. And speaking of the MAX, earlier today when we talked with Steve Dixon, the head of the FAA, he said that this is an airplane that will not be recertified this year.
If you just do the math, it's going to extend into 2020.
So it won't be recertified this year. Do you expect it by the end of January or by the end of February? What would you say is realistic?
It's impossible to say, Phil. I mean, if I had that kind of a crystal ball, I would certainly be able to share it.
As you take a look at shares of Boeing, we should point out that we reached out to Boeing and said, is it still your guidance that this plane will be recertified this year? And they said, we have not changed our guidance. So, guys, that's the latest when it comes to the MAX.
Okay, Phil, thanks so much for that. Josh, your take on Boeing, where we stand? How can they get this type of thing wrong to give the guidance that it could be certified again when clearly it's not the case?
So I don't have like an informed view of when it'll be certified, but I want to make a bigger point, which is that it's extraordinary. We learned today, I think, that absent intervention by the regulators, this is a plane that could have had a crash like this every 2 to 3 years, statistically. And I think this speaks to the need for regulation. We're in this moment right now politically where we're literally chainsawing the rule books in every industry, from energy to finance, etc. And this is the end result, unfortunately. It's well-intentioned. You want to get the economy going. You want to create more jobs. You want to get off the back of the business owner. I totally understand all that. But this is what happens when there's an absence of the right type of regulation, or people too easily can get around regulation, or whatever the case may be. So not that most business failings are plane crashes, but I'm just making this point. We ought to be careful about how deeply we want to cut oversight, because this sometimes can be the end result.
And hopefully now they're going to be very careful with this final decision when this plane does eventually get off the ground. Well, let's talk about Home Depot. Dow component moving lower after forecasting 2020 sales growth below the street's expectations at its investor day. Now, the retailer forecasting sales growth still of 3.5% to 4%, but analysts were thinking closer to 4.3%. And this comes 3 weeks after Home Depot slashed its 2019 sales forecast for a second time. And the reason it said was that its One Depot strategy had yet to bring in as much revenue as it had expected it would. Home Depot also pointed out today that theft from organized retail crime is the reason its operating profit will be lower next year. This actually is a trend that I profiled recently that's been hitting Home Depot and others. If you want to know more about this, check out CNBC.com for more. But today, when it was brought up at the investor conference, this was the first time it really was sort of dug into as having a material impact. And, you know, Mike, when you look at shares of Home Depot, they're down today about 2%, but up 23% year to date. Yeah. Lowe's, however, is actually outperforming that because perhaps it had more room to run from a valuation standpoint.
Yeah, for sure. And it seems like the market is determined. I mean, it is Home Depot more than 10% off its highs. So I think that Home Depot had built up this tremendous premium as the dominant incumbent. You really had these unassailable comp trends and all the rest of it. And it was at a time earlier this year when everyone was buying like the quality balance sheet, the buyback giant. So I think it's just bleeding away some of that premium that it had over Lowe's. And that probably explains most of the back and forth.
Apple hitting new all-time high levels today in today's trade, as two Wall Street firms make bullish calls on the stock. Josh has more for us. Hey, Josh.
So, Wilf, Apple will return to growth. That's Evercore's take. They see upside to the street's estimates for that critical December quarter. And for 2020, the analysts see revenue growth of around 6% as strength in wearables and services offset flat to declining revenue in other products. Their new price target, $305. B of A also remaining bullish, saying Apple shares will benefit from 5G adoption and attractively priced wearables portfolio. And they say hardware revenue growth in the low single digits is reasonable. Their price target moves to $290. These firms not alone. Nearly 60% of analysts now rate Apple a buy. Guys, back to you.
Josh, thanks so much for that. Apple, in part, has helped the market today. And I should mention, we just hit session highs in the last minute or so, so getting a bit more of that impetus. That
we throw in semis here real quick, very important. SMH. I've been saying for a long time I regard the semis as the new transports. Almost every product getting sold these days has a chip or multiple chips in it. This is a key signal for me. The market is voting that things are going to be okay when you see something like this. And it's not just one big component driving it. It's the full spectrum of chips. I guess it's very key. New all-time high, 2% up.
I guess, Mike, though, the market's voting more than it's going to be okay. The risk now is, have we gone ahead of where the global data is? Well, semis, Apple, everything.
Yeah, that is, I mean, certainly that will become the risk at some level. Maybe it's this one, maybe it's higher. With Apple, though, it's funny. It seems like there's this huge bullish stampede of analysts, but what's really going on is the stock eclipsed the consensus price target of the entire street. Right now, the consensus price target is below where the stock is trading. What does an analyst have to do? If you're not going to downgrade the stock, find a rationale to upgrade the price target. That's why you're seeing what looks like people getting way bulled up on Apple. They're just marking their opinion to market at this point. And I still don't think that the sell side is all in on Apple. Josh said 60% of analysts rated to buy. That's not high for the most valuable company in the world that's been on this huge win streak.
To what extent, Mike, have all of the overall market strategists had to do the same to the S&P 500 for next year?
You know, it's happening only grudgingly, I think. I think you have a few 10% up targets right now. It probably will filter through in the next month or so, maybe some of that action.
We've got just 3 minutes left of trade. We are up at 0.3% on the S&P. Mike, you've been looking at the internals.
It's been pretty firm. I mean, if you look at the up and down stocks on the New York Stock Exchange, it has been solidly higher all day. It's obviously not a dramatic move on the index level, but basically you do have some traction there. I was also going to take a note of gold prices. After the Fed, after the Powell press conference, dollar did come down. So gold's up 0.75%, but you look at it's kind of fighting up against that peak of 1560 or so back in early September. That was really at the height of the recession scare. Finally, the volatility index. Normally, after you get the Fed decision, after you get the press conference, a lot more volatility bleeds out of the market. People were kind of hedging for that event risk. Well, this time the event risk comes Sunday. So there's a lot of just sort of stay long stocks, hedge with index puts. That's what's puffing up the VIX well more than you would expect based on the market behavior itself.
And we think it comes Sunday, but maybe it could be Friday, or we don't know.
Exactly.
For sure.
Yes, by Sunday, presumably. And even that, people are saying it's not a hard deadline.
We are higher for all three of the major averages with 2 minutes left of trade. Let's get a check-in on bonds. Rick Santelli.
You know, Wilf, if you looked at the last time the Fed eased on October 30th, that was sort of a cycle low. Rates moved up after that. No ease this time, but we certainly have slipped. Let's see if we put in a bottom, at least temporarily. Look at a 2-year note. It's falling. The whole curve's falling, and everything other than 2 years making new low yield closes for the week. Look at the 10-year, 179 -5. Twos are down 4. Curve flattening. Finally, the dollar index, biggest mover, down 1/3%. Open the chart up. Lowest close since the 18th of July in Bertha. The NASDAQ's going to close above yesterday's highs.
We are, and that is really fueled by chips today, with chips up 2% at an all-time high. A number of those names joining that list, including Cirrus Logic, Skyworks at a 52-week high, but ASML and Cirrus at all-time highs. Lululemon as well, ahead of its earnings. That is the 4th best performer and gainer in the NASDAQ 100 this year, continuing to hit all-time highs. And today we had a big IPO here at the NASDAQ. XP, that's a fintech firm from Brazil, priced well above the range, got a very nice pop. The 179th IPO for the NASDAQ, which this year has beaten so far the NYSE, both on the number of IPOs and on the amount of money raised on those deals. Over to Bob.
Fed standing pat, Bertha, and the important thing here, 8 points on the move on the S&P on the Fed, 31.41. Remember, old closing high, 31.53 on the S&P 500. We're less than a half a point away in a lot of sectors, communication, healthcare, consumer staples, essentially at new highs. Elsewhere, a couple nice moves in these metal stocks in the last few days. People seem to be thinking much more optimistically about things like Freeport, McMoran, that have been moving up in the last few days. Finally, good day for home builders. D.R. Horton, new high for that particular stock. We are closing essentially right near the highs of the day. Dow up 41 points. S&P 500 up 10 points.
Welcome to the Closing Bell, everyone. I'm Wilfred Frost.
And I'm Courtney Reagan in for Sarah Eisen, along with Mike Santoli, CNBC Senior Markets Commentator.
Let's check in on where the markets closed. As Bob Pisani just told you, at the session, highs up 0.3% for the Dow. For the S&P, the Dow just slightly higher. The NASDAQ up 0.5%. A little bit of positive impetus into the close, as you can see there from the intraday chart on the S&P, 0.3% higher.
Well, coming up, we're going to get earnings from retailer Lululemon. We'll bring you those numbers as soon as they cross. Those shares were higher going into the close, and they've been up about 90% year to date. Joining us to talk about the market day, Josh Brown, CEO of Ritholtz Wealth Management. He's still with us. And Liz Ann Saunders joins us, Chief Investment Strategist at Charles Schwab. Mike, here we go. We ended the day higher after largely expected Fed conference, but like you mentioned previously, we have a very big uncertainty factor hanging out there still.
Yeah, that is the one thing that is detracting from what is otherwise a very comfortable setup, I think, right now. The Fed has basically told you that real short-term interest rates are going to stay negative for a while. They're going to wait until inflation picks up before they do anything to the upside with the rates. Right now, very accommodative. Credit markets love it. There's a firm base for equity valuations because of that. And by the way, historically, for the last 25 years, when the Fed does not change on a meeting, does not change rates, that's the more bullish scenario for the next month. That makes sense. It means that the conditions are pretty good. So all that fits together, and then all you wonder is, has the rally stretched itself a little bit too far here since October? We've struggled at the highs for a few weeks right now. And of course, yes, we have this trade deadline out there, which could just change the equation, I think, just for the short-term tactical picture as opposed to the overall one.
Lizanne, if the Fed doesn't change rates at all throughout 2020, where do you stand on the S&P 500 forecast for the end of next year?
Well, I think if the economic environment justifies that and we stay in sort of a steady state of growth without an uptick in inflation, that's not a bad thing. You know, Mike talked about how the market has done a month after the Fed announces a pause or doesn't do anything is actually the best of the other two scenarios included. And I think if you look at three rate cuts in the past when we've gotten there, the further the Fed goes from the third rate cut, if they continue to cut, it's usually because we're entering into or they're trying to combat a recession. That's obviously not good for the stock market. So a Fed that doesn't have much more to go on the downside in terms of cutting and sort of stands pat, history suggests that's not a bad environment for the market.
Josh, what do you make about where we are sitting going into year end after we had that scare at the end of December last year? Any chance we see something like that again?
Still possible, but the winners of that scare were the people who didn't notice it. Maybe they hadn't logged into their brokerage account for a week or so. They did okay. Lizanne, I'm curious what your thoughts are about the dollar. A lot of people are talking about this uptrend that it's been in really all year long, and now it appears to be at the lower end of that trend channel. Is there something important to consider if, in fact, the dollar technically breaks down? What might the impact be on things like earnings or sentiment? How do you think about that?
Well, I think if it were to break down outside of the range that I think is embedded into things like earnings forecasts looking ahead, particularly for exporters, I think that would probably be a benefit to S&P earnings. Of course, there are a lot of other uncertainties that I think have put the analyst community in a state of uncertainty, not least being the December 15th tariff. So I think the dollar piece of it may add some clarity for the manufacturers, for the export-oriented companies, but it doesn't necessarily solve the uncertainty with regard to the near-term trajectory for tariffs and the impact that that's going to have, maybe not as much on profits themselves, but profit margins.
Well, the Federal Reserve leaving interest rates unchanged, as you may know by now. In his press conference, Fed Chairman Jerome Powell weighing in on the role of monetary policy amid trade uncertainty.
We try to look through the volatility in trade news and trade negotiations. We try not to react. We can't react. Monetary policy is not the right tool to react in the very short term to volatility and things that can change back and forth, as this has happened.
And Lizanne, of course, there is a very big difference between monetary policy and fiscal policy, but the Fed has to be paying attention. What do you think the market reaction will be if we get a true resolution of this trade deal, even if it's just phase one?
I think phase one could not be defined as a true resolution, and I think Powell has been right in stressing that there's only so much monetary policy can do to support that. I also think Powell emphasized again what I think is one of the most important messages he has put out there for at least the past year, which is it's important for the Fed to differentiate between financial system stability and financial market volatility, and that they're not going to move levers purely on the latter, purely on market volatility. So I like the fact that he emphasized that today, because I think there are some maybe newer players in the market that think with any kind of knee-jerk move in volatility that the Fed is going to step in and move one direction or another, but also supporting the notion that the Fed can only do so much to support an economy that is plagued, at least on the manufacturing side, by uncertainty associated with trade, and the Fed can't do anything about that.
Josh, if we do get December 15th tariffs taken off the table and the Fed stays on hold all through next year like currently predicted, what's the key thing you focus on for 2020? Is it back to earnings?
I think one of the more, always. So to answer your question, interest rates and earnings over everything else. Okay, so let's put those two things aside. I think one of the more interesting things that we're looking at is the strength in emerging markets, not just in share prices, which I'll talk about in 1 second, but even earnings expectations. Even if they're too high, you're still going to get more earnings growth in EM than you're going to get in the United States. And I can't remember the last time that you've been able to say that with a straight face. Let's look at IEMG. This is probably the cheapest way to own the emerging markets as a group. This ETF is starting to look really interesting on a 1 year and a 3 year time frame. The lows are higher lows, and the buyers are coming in technically exactly where they should. This has been an out of favor asset class for a long time. I think it could be a sleeper hit for next year. It's It's been so long since it's had an outperformance. That would be a really interesting surprise.
Earlier today, I spoke with Brian Moynihan, the chairman and CEO of Bank of America, about the way tech is supposedly threatening his business. He outlined how he believes tech, paired with the bank scale, is in fact a big bonus for Bank of America.
We believe our products and services are better than any challenger and any mainstream competitor, whatever characterization you want to put. We study everybody. We see what customers need. But the real difference is our ability to invest at scale and get scale out of our investments. So we have 35 million round numbers of digital customers, 29 million mobile customers. The idea of the scale advantage of being larger is being proven out, not only by the largest, but also the mid-sized banks who get more scale and the ability to get efficiencies in everything you have. But what's really different from back then is the ability to have a national brand. Only in the 80s have you been able to have a national franchise first started, and it wasn't national. Now you can have that. So our ability to go in a place like Denver, which we did about 4 or 5 years ago, and get to number 8 position very quickly with $100 million plus an average branch size is because our national brand leads us. And that's what competitors have to think about. We actually are growing organically at a faster rate in terms of activity than we've ever grown at during this time. And that shows you the power of really, frankly, having a company that had to go through so much in the early part of my tenure, in the early part of the decade, and restructure it.
Of course, the stock up today. The other banks were slightly lower. It comes off the back of as well comments, encouraging comments about the economy, particularly the consumer, and upgrades to their outlook for Q4 on trading and investment banking, akin to some of the other banks as well. I think strategically, though, on this, Bank of America is very well placed. The markets come into this already. JP Morgan and Bank of America in particular are trading at premiums relative to their own history on their earnings multiple. But this is a big question for the next decade. Does tech hurt the incumbents like it has in retail, or does it in fact aid them? And you listen to Moynihan's comments there today and in his presentation earlier in the session. Very much he's a believer that it helps them, doesn't hinder them.
Yeah, very hard to dispute the idea that a Bank of America with the scale is hard to dislodge, and the spending power they have on technology and all the rest of it is hard to match. I just wonder if the effect would be more that technology changes the pricing and sort of attacks in general industry margins as opposed to really grabbing huge chunks of market share. That's a question for the long term. I don't really know the difference for B of A right now in terms of making the determination on the stock.
I think that's definitely a question. And interestingly, on the broker price war, we've seen an example of that. A Robinhood comes in, it leads to a price war. Does the end winner end up being Charles Schwab, i.e. the big player? But they go through a period of price pressure in the process. Perhaps, that said, on that particular topic, which we discussed, he was like, I don't understand this price war debate because we cut prices for trades to zero in 2005, 2006, or whatever date it was he said. So
right. with a
clients.
relationship with the firm.
Right, exactly. I just, either way, the long-term winner probably is the bigger player, even if prices are pressured in the meantime.
Something interesting happens when technology comes in and disrupts an industry. For the first 2 or 3 years, you assume the incumbents are dead because the other companies are moving so fast and all the metrics they're reporting are eye-popping. We doubled, we tripled. But then the incumbent starts to figure out how to play the same game. And they can play it with, to Michael's point, they've got the scale, the resources. They eventually get it right in a lot of cases. And I think in banking, you're going to see that. You're going to see these guys play offense now and use the power of the existing brand and franchise to do it.
You were suggesting buying JPM a few weeks back. Are you still long any of the banks?
Oh, I've been long JPM for years. New all-time high almost every week over the last few months. Bank of America is interesting. 54% return over the last 3 years, but almost all of it has occurred in the last 8 months. But they're not getting any credit for all of the great things Moynihan's talking about because it's an 11 earnings multiple. So the market is not saying, yeah, you guys are killing it. Maybe that happens and you get multiple expansion in these banks, but that really has not arrived for Bank of America just yet.
10 years at the helm as CEO for Brian Moynihan as of next week. The full interview online, CNBC.com. Lululemon earnings are out. Meg Terrell's got them for us. Hey, Meg.
Hey, well, what looks like a beat on both the top and the bottom line for Lululemon in the third quarter. Revenue coming in at $916 million, compared with analysts' average estimate of about $900 million. EPS at 96 cents, beat by 3 cents, the average estimate. The stock is down more than 5% in the after hours, perhaps on a slightly light fourth quarter guidance from the company. They forecast revenue of up to $1.33 billion. The street was looking for up to $1.385 billion. And on the EPS number, they forecast $2.10 to $2.13, whereas the street's looking for $2.08 to $2.23, guys. But again, a beat for the quarter. Comparable sales also beating at 16% compared with about 14% the street was looking for. So pretty good quarter, but clearly high expectations for Lululemon going into it. And you are seeing the stock down a bit, guys.
Very high expectations, Meg. Thank you very much. I mean, Mike, the comparable store sales, though, increased 10%. Store sales.
Stores,
that
yeah.
is really, really strong. And Lululemon tends to be a little conservative on its guidance anyways, but it does seem like shares are reacting here.
They are definitely reacting, as we were talking about. I mean, the field position was very tough. The stock is up a ton. And, roughly on target guidance is maybe not enough to get it moving immediately. This isn't that big a move. It doesn't cut too much into the recent gains. This little drop to the downside. So we'll see where it settles out. But it's not too much in the numbers you would say it changes the story whatsoever.
57 times earnings for sweatpants. If you're unhappy...
40 times forward.
Forward, fine. It's about a 30 enterprise value to EBITDA multiple.
It's a $30 billion company. It's 5 times the size of Gap right now.
Right. So if you're not happy with what the stock has done, because it's off 4% today after doubling, I don't really know what to tell you. Your expectations might have been a little bit too high. Stocks had an amazing run.
Is it possible that they're just taking investors are taking opportunity to take some money off the table? I mean, 90% year to date.
Go look back at post-earnings reactions for this stock over the last 2 years. You've seen one or the other. You've seen it fall off and then recover a week later when people realized, wait, I just sold Lulu. What else am I buying in this space? Oh, that's right. Absolutely nothing.
Except for maybe Macy's, your last chance trade.
Yeah, sure.
We'll see.
No competition between those two.
I'm just teasing. All right, well, thank you, Josh Brown and Liz Ann Saunders, for joining us here today on the Closing Bell Market Zone. Well, up next, former Minneapolis Fed President Narayana Kocherlakota and former Fed Governor Sarah Bloom Raskin weigh in on the Fed's decision to leave rates unchanged. We'll ask them if that was the right move for the economy. Don't go anywhere. Closing Bell's back in just 90 seconds.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, hook, into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip Bayless.
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
Hey, NFL fan, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you already have an all-access pass to every team and every game in the league. Amazing, right?
Steps up, floats it towards, at the goal line, it's intercepted.
Listen live as the action unfolds or on demand when you can. Anytime, anywhere, all season long.
Right side, it is caught. It is in for the right side for the touchdown.
Search NFL today.
A lot of people aren't aware that TuneIn lets you listen to the same terrestrial stations that you pick up on your FM AM dial, except you can hear them from anywhere. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
In Washington, D.C., there's only one word in everybody's mouth: impeachment. As the impeachment process moves on to the next stage, don't miss history unfolding on TuneIn. Wherever you are when the latest witness takes the stand, you can listen to every hearing live as it's happening on Capitol Hill. And between hearings, turn to stations like CNN, MSNBC, and Fox News Talk for bombshells, breaking headlines, and bold analysis every step of the way. Search Impeachment News on TuneIn to hear the latest.
Welcome back. The Fed leaving rates unchanged, but a year ago everything was fairly different. Fed Chair Jay Powell had raised rates for the 4th time in a year, and stocks saw a significant sell-off, raising concerns about the economy and market. Fast forward 12 months, Chair Powell has cut rates 3 times. Stocks are 25% higher. Well, what will the next 12 months bring? Let's bring in former Minneapolis Fed President Narayana Kocherlakota and former Fed Governor and CNBC contributor Sarah Bloom Raskin. A very good afternoon to you both. Sarah, I'll start with you. The discussion we had earlier was that it's clear from the Fed chair that the hurdle to hike is infinitely higher than to cut, but that nonetheless the base case now is no action next year. What's your takeaway?
Right. That's exactly the read, and I think that was the communication that Chair Powell put out in the press conference as well. The indicators, though, are still coming in, and they will continue to come in next year, and I think there will be some storm clouds. In particular, manufacturing. Manufacturing is something that is still not looking good. In fact, we just saw that U.S. manufacturers for the first time are not going to be spending more next year. And this hasn't happened since I think, 2009. Manufacturing is still down. Business investment still down. Productivity, the productivity numbers are coming in slightly lower as well. So I don't think the storm clouds have really dissipated. And we also have to keep in mind that, from the perspective of the economy, monetary policy is not the only game in town. And the role that fiscal policy is going to play to deal with some of the longer-term structural issues, I think, is something that the Fed's going to have to keep an eye on.
Mariana, Sarah brings up some good points here. If we continue to see the divergence widen between the factors that are strong, like the consumer, and those that are weak, like manufacturing and business investment, can we continue to see growth at the same level, or will that naturally start to fall?
Yeah, that's a great question. And these are exactly the questions the Fed's going to have to be watching in 2020. The no rate case is the base case, but no rate hike case or no rate cut case is the base case. But we're going to have to be watching for exactly, do we have enough internal strength in the economy to outweigh the global factors that are weighing on manufacturing. The consumer has continued to carry the U.S. economy forward. I myself would bet on that continuing to happen in 2020, but that's exactly what the Fed has to be watching as we head into next year.
So, Sarah, do you feel like the temporary truce that we had between the Fed and the president will continue, or the fact that we didn't see a cut today will lead to a re-escalation of that?
Well, I don't know if today's action will lead to a re-escalation, but I think a re-escalation of those, that kind of bullying behavior is going to reemerge for sure. Because if you look at the pattern of it, it pretty much emerges when the markets do something that the president doesn't like, particularly when the markets go down. He will want to blame the Fed, and I have no reason to think that that technique is coming to an end. From some people's perspective, it's actually been kind of effective. The president has actually gotten what he has wanted from the Fed, with the exception of negative interest rates. But it has, in some sense, worked. Now, from the institutional perspective of Fed independence, I would say it has been really bad.
Mariana, Chairman Powell was very focused on inflation and where it sits currently and his targets for the future. You seem also concerned about inflation. What are your thoughts about where we are and where we're headed for these key metrics?
Yeah, Courtney, that's a concern I've had for 5 years, and I continue to have. Inflation remains not well below target, but it remains below target. Has been below target really for about 11 years, since the dark days of 2008. And what puzzles me about the Fed is you'll hear a lot of words about we're committed to our target. We're committed to symmetry around our target. If you're truly committed to it and inflation continues to run below target in your forecast, well, that means you should be easing policy. So I think that's the question that the Fed has to be better at answering, which is, what are the costs of easing policy further in this environment? If you're not worried about inflation, and I think Chair Powell was clear in the press conferences, he would welcome above 2% inflation. If that's the case, why not ease policy still further? And I've been puzzled by this question for 5 years. I suspect I'll remain puzzled by it in the coming year.
Well, Mariana, though, there was a question posed to Chair Powell in the press conference, and it's the big one that hangs over this, which is, why would you think that incremental easing from here would, in fact, allow the Fed to meet its inflation target or to accelerate the rise in prices from here? Since it didn't happen at the zero lower bound, the economy is kind of producing roughly the same amount of inflation now, and even when the Fed funds rate was up by around 2%, as when it was near zero.
No, I think that the impact, I think Chair Powell answered this, addressed this issue in the press conference. The impact of slack on inflation is quite muted, but it is nonetheless there. And I agreed with the statements he made along those lines. But what that means is you have to be willing to bring unemployment well below what you believe is the natural rate in order to have a sizable impact on inflation. So right now we're maybe 40, 50 basis points below what the Fed thinks is the natural rate of unemployment. I personally think we're at the natural rate of unemployment. So at that point, you're going to have to do even more in labor markets to stimulate wage growth, and that will start to spill into inflation. But the point is, the impact is muted, but it's not zero by any means. We've started to see the wage growth. We will see the inflation. The story the Fed tells where, boy, we don't know where the inflation is. Let's raise rates. It just doesn't hang together.
Mariana and Sarah Bloom-Raskin, thank you for joining us here today on Fed Decision Day.
Thanks.
Well, coming up next, we will break down the latest data to find out whether retail stocks are poised for a holiday shopping surge.
Plus, we'll discuss whether the IPO market will rebound next year when we speak to former Reddit CEO Alexis Ohanian.
This CNBC program is sponsored by...
Today, your information is more exposed than ever. When you shop, sign in, or browse, you could be vulnerable to cybercriminals. More online threats demand more protection. That's why new Norton 360 provides multiple layers of protection, combining device security, secure VPN, password manager, and cloud backup all in one solution. Get new Norton 360, starting at $24.99 for the first year.
Hey, tune in listeners, Steve Kornacki here from NBC News. I want to tell you about a podcast I'm hosting called Article 2, Inside Impeachment. It's dedicated to bringing you the latest developments on the impeachment inquiry into President Trump. Every Monday, Wednesday, and Friday, I talk to NBC News reporters who are closest to the story to break down what's new, what matters, and what it means for the 2020 election. Search and favorite Article 2, Inside Impeachment on TuneIn.
Some days life can get in the way of catching up on the news that moves your world. TuneIn is here to help. With live 24/7 coverage from CNN wherever you go on the TuneIn app, you can always find a slice of your schedule, however long, to check in on the biggest stories of the day.
Hell hath no fury. The president's counselor went on a rampage on a taped phone call with Washington Examiner reporter.
Search CNN on TuneIn to get the live news when it matters most.
Introducing a new podcast, ESPN Daily. When you want to go beyond your feed, when you want to get inside the score, when you want to get behind the highlight, there's ESPN Daily. Go deeper into the stories of the moment. Get the exclusive access and insider perspective that only ESPN can give you. ESPN Daily, hosted by me, Mina Kimes. Listen now to ESPN Daily on TuneIn.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip
Follow
Bayless.
at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
Welcome back to the Closing Bell. Let's send it over to Mike Santoli. He's got a chart for us here today.
I do, Court. Well, I guess we're roughly halfway through the holiday shopping season if it started at Thanksgiving here on the 11th. This is Bank of America's proxy for holiday retail sales. You see that this is the estimate for the current year. It is above the decade average, which is, I guess, around 4%. So they're looking for something like a 5% top line economy-wide holiday sales. Obviously, better than average, but not quite as good potentially as back in 2017. Take a look at the performance over several different retail stock measures. The market seems to have kind of taken it as a premise that the consumer's in pretty good shape. The retail sales are strong. This retail sector fund, RTH, it's market cap weighted. So essentially, it's actually 30% Amazon and Home Depot and Both of those stocks have actually been struggling a little bit lately, but you see it's roughly been performing in line with the S&P 500. I did put Amazon in there as well, so up 16% year to date. It's been really, though, conspicuous in its underperformance lately. I think a lot of folks are looking at this just as a psychological proxy. I think you could also say, by the way, the fact the S&P and the NASDAQ have been basically at highs without Amazon helping out at all probably tells you something, too. So maybe that's not really a tell on the consumer or retail. It's sentiment toward the overall business at Amazon.
Okay, Mike, thanks very much for that. We've got a newsletter on Continental Resources. Bill Griffith has it for us. Hey, Bill.
We do, Wilf, on a year when we have learned that it's been a record year for CEO exits. This is another one. Harold Hamm, the high-profile, outspoken founder and CEO of Continental, is, as the company puts it, stepping up. He's not stepping down. He's going to become the executive chairman come Jan 1, and he'll be replaced by William Berry, and then Jack Stark will be the chief operating officer. Of course, Continental has been on the forefront of leading the latest oil boom in this country in the Bakken, which has led to a tremendous production in this country and making us oil independent. And Harold Hamm is usually the go-to guy when we want to talk to somebody about that boom in the Bakken and other parts of the country. So Harold Hamm stepping up from the position of CEO.